Hey there, everyone. It's fantastic to have you with us today. Let's dive deep into a topic that sits at the core of financial stability, risk management systems in the banking sector. Now, if you've ever wondered what keeps our banks from faltering and how they navigate the stormy seas of financial risks, then you're in the right place. First off, let's make it a bit interactive. Raise your virtual hand if you've ever heard a story about a financial crisis. How many of us remember 2008? It was a wild ride, right? The truth is, crisis management stems from robust risk management systems, and we're going to break that down together. So, what exactly is risk management? At its heart, it's about identifying, assessing, and prioritizing risks. But here's where it gets interesting. In the banking sector, these risks can come from various sources. We've got credit risk, market risk, operational risk, and just when you thought it couldn't get more exciting, we've got liquidity risk too. Let's take a closer look at credit risk. This is essentially the risk of loss arising from a borrower failing to repay a loan. How do banks mitigate this? Well, they use rigorous credit assessments and scoring systems to evaluate the likelihood of default. Think about that for a second. Each loan application goes through a process that is, at times, longer than the actual loan period. Isn't that wild? Now, market risk. This is all about the uncertainty of the financial markets. Imagine you're sipping your morning coffee, and suddenly, the value of stocks tank. Banks are constantly at the mercy of changes in market conditions. So, how do they manage this? Using value-at-risk modeling. It sounds complex, but it's really just a way of quantifying how much capital they could potentially lose on their trading positions. Next, let's talk about operational risk. This is the risk of loss from inadequate or failed internal processes, people, and systems, or from external events. You know, like a computer system going down or a natural disaster affecting operations. Banks implement strict internal controls and disaster recovery plans to combat these risks. Can you imagine the level of planning that goes into ensuring these systems remain functional? Oh, and we can't forget liquidity risk. This is crucial because it determines a bank's capability to meet its short-term financial obligations. Banks maintain a balance of assets that can be quickly turned into cash. Ever heard of liquidity coverage ratios? Yes, those measures safeguard banks against unexpected disruptions. So, now that we've painted a picture of these various risks, let's discuss risk management frameworks. Picture this: resilient frameworks act like a shield protecting banks from the unexpected. They allow banks to anticipate and respond to potential threats efficiently. Have you ever thought about how regulations play a role in risk management? Key regulations like Basel III help standardize how much capital banks must hold to buffer against their risks. It's pretty fascinating how regulations work as both rules and safety nets. And what about technology? Oh boy, where would we be without tech? Advanced analytics and AI tools are stepping into risk management, providing banks with insights that were unthinkable a decade ago. Are any of you intrigued by how technology is shaping the landscape of risk management? I hope so. As we wrap up this discussion, remember that effective risk management isn't just a reactive tool. It's a proactive strategy that ensures the stability of the banking sector, protects consumers, and fortifies our economy. What's your takeaway from today's session? I would love to hear your thoughts in the comments. And if you're eager to expand your knowledge even further, I encourage you to explore literature on this topic. Like Mastering Risk Management, you won't want to miss out on the valuable insights it offers. If you found this discussion helpful, make sure to subscribe to our channel for more engaging content. Trust me, you don't want to miss what we have coming up. Thanks for staying with us, and see you next time with more intriguing insights into the world of finance.